Most people think that wearing a white coat is a guaranteed ticket to a life of luxury. However, the reality is that many physicians are actually living paycheck to paycheck. This is the high-income trap. We spend our 20s in classrooms and our 30s in residency, while our peers are already climbing the corporate ladder and investing. By the time that first attending paycheck hits, we are often staring down six-figure student loans and a decade of missed compound interest. The biggest danger isn't the debt itself. It is lifestyle creep. You see your colleagues buying the luxury SUV or the 5-bedroom house, and you feel you deserve it after all those grueling shifts. But every dollar you spend on a status symbol today is a dollar that isn't working for you in the market. To build real wealth, you must live like a resident even when you are finally making big money. My plan starts with a wealth ratio. If you are spending more than 60% of your take-home pay on your lifestyle in these early years, you are not building wealth, you are just managing a high-income treadmill. We need to flip the script immediately. We are going to treat your financial health with the same diagnostic rigor you use for a patient. No emotion, just raw data. You cannot out-earn a bad spending habit, no matter how high your salary goes. The trap is set the moment you try to look rich before you actually are rich. Understanding this delay in wealth accumulation is the first step toward a cure. We must prioritize assets over appearances if we want to reach true financial independence before our 65th birthday. This is the foundation of the doctor's financial plan. Not all debt is created equal. In the medical world, we prioritize patients based on the severity of their condition, that is triage. You must triage your debt. My plan splits debt into two categories: cancers and common colds. Anything with an interest rate above 7% is a cancer. This is usually credit card debt or high-interest private student loans. These must be aggressively excised. Every extra dollar you have goes here first. Anything below 4%, like a conservative mortgage or older federal loans, is a common cold. You can live with it while you invest. If you have $200,000 in loans at 6% interest, and you only pay the minimum, you are effectively burning thousands of dollars every year in pure interest. That is money that could be compounding in your favor. My strategy involves refinancing student loans the moment you have a stable contract to drop that rate by even 1 or 2%. That small shift can save you the price of a small house over 20 years. Don't let the interest eat your future while you are busy saving lives. Many doctors make the mistake of paying off low-interest debt while ignoring the stock market, or worse, carrying high-interest debt while trying to pick individual stocks. You need to be systematic. Use the debt avalanche method to kill high-interest loans first. This isn't just about math. It is about psychological freedom. Once the cancer debt is gone, your cash flow opens up, allowing you to move from a defensive position to an offensive one. We are looking for a clean bill of financial health. By treating your debt with surgical precision, you ensure that your hard-earned income stays in your pocket instead of the bank. In medicine, we never go into a procedure without a backup plan. Your finances need an emergency room fund. For a doctor, this is more critical than for most professionals. Why? Because our overhead is high and our specialized skills are hard to pivot quickly. If you cannot work, the bills do not stop. I recommend a liquid fund covering 6 months of your essential expenses. If your life costs $10,000 a month, you need $60,000 sitting in a high-yield savings account. It might feel boring to have that much cash not invested, but this is your insurance against the unexpected. This also includes own occupation disability insurance. This is the most underrated part of a doctor's financial plan. If you are a surgeon and you lose the use of your hand, you want insurance that pays out because you cannot perform surgery, not just because you cannot work any job. This safety net allows you to invest aggressively because you are not playing with your survival money. You are playing with your wealth money. When the foundation is solid, the skyscraper can grow safely. Without this fund, one bad month can force you to liquidate your investments at the worst possible time. Think of this as your financial life support system. It must be fully funded before you start chasing risky ventures or private equity deals. High earners are often targets for get-rich-quick schemes, but a doctor with a solid safety net can simply say no. We build this wall of cash to protect our peace of mind. Once your emergency fund is at 100% of its target, you have earned the right to move into the aggressive growth phase of your long-term financial journey. The government is your biggest expense as a high-earning physician. You could easily be losing 35 to 40% of your income to taxes. My plan involves using every legal prescription to lower that bill. First, the 401,000 or 403b. You must contribute the maximum allowed amount every year. If your employer offers a match, that is a 100% return on your money instantly. Next is the backdoor Roth IRA. Since doctors earn too much for a standard Roth, we have to use this specific maneuver. It is perfectly legal and essential for tax-free growth. Finally, the health savings account or HSA. This is the triple threat of the financial world. The money goes in tax-free, grows tax-free, and comes out tax-free for medical expenses. Since we are doctors, we know medical expenses are inevitable. By maxing these out, you could be shielding $50,000 or more from being taxed at your highest bracket. Over 30 years, that tax savings alone will grow into millions of dollars. You wouldn't ignore a life-saving prescription for a patient. Don't ignore these for your bank account. Tax efficiency is the silent partner in wealth building. If you can lower your effective tax rate by even 5%, that is equivalent to a massive raise without working a single extra hour. We want to be efficient with our earnings. Every dollar saved from the tax collector is a dollar that can be reinvested into your future. This is not about avoiding your civic duty. It is about using the rules written in the tax code to your advantage. A doctor who ignores tax-advantaged accounts is essentially working for the government for 3 months out of every single year. Doctors are often the targets of complex investment schemes, expensive whole life insurance, private equity deals, or hot stock tips from the locker room. My plan ignores the noise. We use the precision of index funds. Why? Because data shows that 90% of professional money managers cannot beat the S&P 500 index over a 10-year period. If they cannot do it, we who are busy in the clinic certainly will not. I put my money into broad market index funds with low expense ratios, ideally below 0.1%. We want to own the entire economy, not just one company. This is set it and forget it investing. Whether the market is up 10% or down 20%, we keep buying. This is dollar cost averaging. In the long run, the market has historically returned about 7 to 10% annually. If you invest $5,000 a month starting at age 30, by age 60, you are looking at over $6 million. That is the power of compound interest. It isn't sexy, and it doesn't make for great party conversation, but it is the most reliable way to ensure you never have to work a night shift in your 60s unless you want to. Complexity is the enemy of execution. Many doctors lose money trying to be smart investors when they should be consistent investors. Your job is to be the best doctor you can be. Let the top 500 companies in the world do the heavy lifting for your portfolio. By owning the whole market, you eliminate uncompensated risk. You are betting on human ingenuity and global growth. Over decades, this simple strategy has created more medical millionaires than any private hospital or boutique investment firm ever has. Financial independence isn't about quitting medicine. It is about work choice. It is the point where your investments generate enough income to cover your life. My final step is calculating your FI number. Take your annual expenses and multiply them by 25. If you spend $100,000 a year, you need $2.5 million to be financially independent. Once you hit that number, you can follow the 4% rule, withdrawing that amount annually with a high probability of never running out of money. My plan includes a glide path. As I get closer to retirement, I shift some of my aggressive stock holdings into safer bonds or real estate to protect the principal. But the ultimate goal is freedom. Freedom to take fewer calls, freedom to spend more time with family, and freedom to practice medicine because you love it, not because you owe the bank. This is the doctor's financial plan. It requires discipline, patience, and a refusal to play the status game. Follow these steps, and you won't just be a successful doctor, you will be a wealthy one. We must remember that wealth is not what you earn, but what you keep and grow. Your career in medicine is a marathon, not a sprint. By the time you reach the finish line, you want to ensure your financial health is as robust as the physical health you provide to your patients. This plan is your roadmap to a life where time is your most valuable asset. Once you reach 100% of your goal, the world opens up. You can choose to teach, to volunteer, or to retire entirely. That is the ultimate success. Thanks for watching Bet on Money. Subscribe for more financial health tips.